It's time for charting futures. Here's Abigail Doolittle. And Abigail, well, the quarter is definitely drawing to an end. What does it look like in the futures market?
Well, Caroline, to borrow Romaine's phrase from earlier, a bit wacky. Let's take a look at some of the futures over the last quarter, because it really is out of sync to some degree. Take a look at the S&P 500 E-minis, up 1.2% on the quarter, so that's bullish. But we have the 10-year note also higher, and that, of course, is yields have rallied in a big way, falling off by more than 30 basis points. So that is actually bearish, at least for risk assets. So you have one risk on, one risk off signal, and then both copper and crude on the quarter lower. Crude for a second quarter in a row. That would also be risk off, considering those are risk assets. So net, it's wacky, but it's probably a tad more risk off than risk on, at least this particular board. What I would like to focus on, though, is a divergence that we've been focusing on a lot, because at some point it's going to come back together. I'd be really curious to see what Bloomberg's Mike McGlone, who will be joining us in a moment, thinks about this. What we're looking at, and why does the S&P 500 out of the presidential inauguration back in January of 2016, and then we of course have the Bloomberg Commodity Index in blue. And we see for a period of time both of these risk asset indexes following each other, and then we see a big separation last year. Stocks going higher, commodities going lower, stocks following in that volatile fourth quarter. And now we have this huge divergence. The S&P 500 up more than 10% over this time period. The Bloomberg Commodity Index down 12%, really over the time period of the trade war in particular. Mike McGlone, thanks for joining us for charting futures. And what do you think about that divergence? Because typically you want to see stocks and commodities trade together, both risk assets and signals of a healthy or an unhealthy economy, whereas that seems to be giving two signals.
I'm afraid it's going to get worse for commodities, and hopefully the stocks won't follow commodities, but the environment for commodities is not good until we get some kind of definitive trade agreement, and who knows when that's going to happen.
And in particular, you do not like crude oil, and you have a great chart here of crude oil to back that up.
Well, I hate to not like, but Matt, if you can narrow in over here, we have a trending market that's down. Everything was narrowing in on a wedge here, 60 resistance, 50 support. This is WTI crude. Market pops above and it fails. That's a classic failure I'm really worried about, because all you do is you kind of squeeze out all the negative gamma shorts. And now the risk is, I think you close right back below the 52-week average, down, probably get down to 50, and that's what I'm worried about. In the meantime, also, what you see is this orange line, that's volatility's picking up. So I look at this as I want to be responsively probably long puts or put spreads, because volatility is going up. And I look at 50 as probably the key strike to watch. And that's what I see as a bear market there, and I'm worried it's going to break down.
So I love the fact that you're pointing out that false initial reaction, because a lot of times they can produce violent moves in the opposite direction. Something that I often talk about with charts, it's not the range itself that actually matters, and the range that you're talking about would bring oil back down closer to 50, but it's the way the range breaks, because all of that represents all of the uncertainty on the part of the bulls and the bears. So if you had to take a guess, because it's going to be a big move up or a big move down, do you think that that range right now is more likely what direction?
The risk is your breakout down, because we went up high, we flushed out all those weak shorts, those calls, everything, and now the downside is a big gap down. It needs a good reason not to go lower, and that's what I'm afraid it's not going to have.
And that range suggests we could actually go below the 2015-2016 low, so stay tuned. So we, of course, are going to take a look at options, and I'd love to take a look at the options monitor, the OMON function here in the Bloomberg. This shows all of the calls and the puts for crude oil futures, but you are going to simplify it for us. We have a couple great points here on what you would do with your bearish view on
Perfect.
oil.
Simple option strategies. Look where the concentration of open interest is. And it's on the 50 put. We don't really show it here, but in December, there's 37,000 contracts open interest. You can compare that to like the 50 put. Can compare that to maybe the 53 put. There's only 7,000. So I look at it as an option strategist. I want to be short.
Yeah, we have your bullets.
Yeah, I want to be short. Well, the market's going down. I want to kind of be, if I'm doing a put strategy, maybe short that 50 put, but buy a put in front of it, maybe a 53 put, because the market's going to try to get there. But if it gets to 50, there's a lot of people willing to probably take profits. Volatility might go lower, but you have that strike in front of it, you're doing better. So that's what I see is volatility is on the rise. Want to be long puts. Market should be going lower, and downside is more vulnerable. So put spreads, and where do you pick the strikes? So.